Fed policy mistake, I think there's a big risk of a Fed policy mistake. And in general, I think the central banks of the world, especially in Europe and Japan, are getting together and relying too much on monetary policy expansion. And just in principle, when they engage in this massive monetary accommodation, it doesn't help global growth. It just helps your own country, and it hurts everyone that you trade with, because your products, just became more competitive, and theirs less competitive. So the problem is when we're doing this, massive accommodation like they're doing in Europe right now, and even more so than here, it makes their region more competitive, but it makes ours less competitive. It makes Japan's less competitive, and emerging markets less competitive. So all of those suffer in a small way. And if all the central banks start pursuing these policies like they have been, we're in an era of central bank activism. They're relying so much on this monetary policy to help them out, but they're hurting others at the same time. So what do the other regions do? They do their own. They expand their monetary policy, which temporarily helps them but hurts everyone else. So we have a race, to the bottom of not only currency value, but interest rates. It really affects interest rates as well. That's why throughout much of Europe and in Japan, we see a lot of negative interest rates. And negative interest rates out to 10 years. You imagine you borrow money and you get back less? It's crazy that people would do that. But yet, we have $13 trillion of sovereign debt in the world that is currently yielding a negative return. It doesn't make any sense. So we think there's a big risk of a Fed policy mistake, but it's, again, something that is better than it was at the beginning of the year. Because if you remember, at the beginning of the year, what were they saying? We're going to raise rates 4 times. We're going to go very, very quickly. They actually came right out and said, we don't want there to be any misunderstanding. Now they're saying, well, we're going to be data dependent. We're concerned about financial market stability. We're not sure if we're going to be able to raise, anytime soon. And we don't expect any kind of a raise in the next several meetings. And in fact, it would take a big economic turnaround, I think, to even consider one increase this year, even one. And there's 4 more meetings. So the Fed is in a much better place now as far as being accommodative to the stock market and the economy than where they were at the beginning of the year. They were too hawkish. Now we think they're willing to maintain accommodation. Does that make sense? I don't know how many people have heard of the Taylor rule. Do we have anybody that knows about the Taylor rule here? Taylor rule is an economic model that tries to estimate what the Fed funds rate should be. Okay, it was developed by an economist named John Taylor, and it's widely followed, by economists. And the thing here is that white line that you see there is the Fed funds target rate, and you can kind of see that target rate has been, virtually at 0 for the last 8 years. But the Taylor rule tells us that the Fed funds rate should be higher than it is right now. And it's based on a model of, CPI and GDP growth and a few other things. And it's basically saying that right now, this rate should be about 3%. Our Fed funds rate should be 3%. And yet we still have, we're right now at about 0.5%, let's call it, that's the upper bound. It is crisis level Fed funds rate. But we don't have a crisis. We haven't had a crisis in a long time. So we're getting farther and farther behind. And in fact, right now, I have this little spread chart. We are farther away from the anticipated rate than we have been since we started looking at the model. Right now, we're the farthest away. So the Fed governors watch this. They know about it. They know that we are currently way behind the curve in raising the Fed funds rate. We should have done it. You can see here, we should have really done it in 2014 when it started growing very quickly, the economy and jobs. And had we done it then when we were supposed to, now we could go completely neutral. We could get up to 1% and be completely neutral on rates, and the Fed could even say, hey, we might have to lower rates if economic conditions don't improve. And that would cause the dollar to stay very low and very weak. But right now they're still trying to raise, and that's the problem. So they're behind the 8 ball. We think they've probably already made a mistake, and we hope they don't compound it by trying to raise too soon.